You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Comperl. The opacity and interconnectedness of private credit with the rest of the financial system have caused investors to worry that recent issues are just the tip of a much larger iceberg. Private credit initially emerged to serve middle market firms underserved by traditional banks, but has now evolved into something much bigger that includes retail investors and banks themselves. On today's episode, we talk with Fabio Natalucci, Managing Director at the Andersen Institute for Finance and Economics, about how private credit fits into the financial ecosystem, its recent signs of distress, and whether these vulnerabilities pose a systemic risk. Stay tuned. Coming up soon, our interview with Fabio Natalucci, but first, a quick market update. The war in Iran continued commanding investor focus over the past 2 weeks. Although both the US and Iran have expressed a desire to wind down the conflict, there have been few, if any, concrete signs of actual progress. President Trump's comments this week have ranged from showing interest in ending the war without the Strait of Hormuz reopening, to aggressive threats against Iran if they do not agree to very specific terms. West Texas Intermediate crude oil traded between $86 and $114 the last 2 weeks as various news headlines suggested different trajectories for the war. As of Friday morning, it's up to $112, boosted most recently by President Trump's address Wednesday night that promised more aggressive attacks. The average price for a gallon of unleaded gasoline topped $4 earlier this week for the first time since 2022. The Treasury market mostly took its cues from the war's headlines as well over the last 2 weeks. The 10-year yield broke through 4.30% on March 20th and reached as high as 4.47% last Friday. The same day, the 30-year yield peaked at 4.99%. For yields at the long end of the curve, investors are weighing the war's net impacts for slower growth, higher for longer Fed policy rates, and deficit risks that would come with a protracted conflict. Fed Chair Jerome Powell quelled market fears for a possible rate hike this year during a discussion at Harvard University earlier this week. Although he did not commit to a rate cut anytime soon, his remarks suggested more willingness from the Fed to look past the near-term effects from an energy price increase than markets had been pricing in. 2-year Treasury yields fell close to 10 basis points during Monday's session after Powell's comments. The March jobs report was released this morning and showed payrolls grew by 178,000 last month, and the unemployment rate fell from 4.4% to 4.3%. The detrimental growth impacts from the war will affect the labor market with a lag, so we still view this morning's report as capturing the pre-war labor market. That's all for the market update this time. Now our interview with Fabio Natalucci. Our guest today is Fabio Natalucci, Managing Director at the Andersen Institute for Finance and Economics. Fabio, thanks for coming on the podcast.
Yeah, thank you for inviting me. It's a pleasure.
Our topic today is the rise and risks of private credit. Now, before we get into the most recent developments in private credit, at a high level, Fabio, how does private credit differ from other types of lending like commercial banking or corporate debt?
I think we need to clarify what we mean by private credit, right? I think we are talking about essentially direct lending here. So lending to middle market corporates. Private credit is expanding also in different asset classes. So I think for now, at least, I think it's useful to keep it focused on corporate loans or corporate debt, if you want. When it was growing in terms of like an asset class, like originally was targeting middle market firms. So those are firms that traditionally, because of size, because of riskiness, because of not being rated, they didn't have many alternatives. The only alternative in terms of access to credit was banks, including regional banks. So they were not large enough to be able to access, say, the bond market, for example. So the choice was, if available, bank credit or private credit. Now, obviously, the asset class has grown over time. I remember the first time there was 1 billion deal, it sounded like a big deal. And then it was 2 billion, 3 billion. And in some cases also without involvement of banks at all. So it has expanded essentially from just a middle market tool, it's access to credit available to middle market firms, starting to compete with larger banks also in the larger size deals. essentially blurring the lines between private credit and what traditionally we call broadly syndicated loans, right? Where banks traditionally play a larger role. So this has been, I think, the evolution of the market. The difference is that the lack of involvement in banks, I think the benefits from a borrower perspective, the way it's often framed, is that you have a more, if I can use the word, personalized relationship with the lender. Um, so is able to, in case of stress, for example, is able to follow up with the borrowers, continue to provide credit, support different kind of type of credit available on the menu. And so that's usually how the appeal is sold. That originally, at least, how it was being the benefits, if you want, to private credit were being discussed.
That makes sense that private credit, in the way you describe it, fills this niche where companies are too small to maybe issue corporate debt or equity, and getting a bank loan has its own challenges or difficulties, and that personal relationship is something that they value. Now, from the lender side, a big thing that people talk about is, unlike banks, of course, they are free from a lot of the regulations that have been put in place, especially after the financial crisis. Is private credit's appeal for lenders just a regulatory arbitrage then, or is there something about this structure that they prefer? Because it feels like this setup of direct lending makes risk really concentrated for the lender in a way that they would want to stay away from.
I think there are benefits from having a more diversified source of funding for the economy. Like when there is risk is concentrated on the balance sheet of the individual financial institution, whether this is the banks or someone else. I think that concentration of risk from a financial stability perspective can be problematic. So in principle, being able to have on the menu a broader diversity of source of funding for corporates, I think from a financial stability perspective, it's a plus, it's a positive. It's a positive because different lenders are subject to different regulation. We can discuss the role of regulation, but they also have different risk appetite, different investment horizon. So they can essentially fulfill some of the objectives of the borrower than other financial institutions may not be able. Like the traditional one is institutional investor like pension funds, insurance companies are a more patient approach, have a longer term horizon, so they don't need liquidity the same way other investors may need. Now, what has been driving this push away, if you want, from the banks into other corners of the financial system? I think there are at least three factors in place. One is the one you mentioned, which is regulation, in the sense that particularly after the financial crisis in 2007, 2008, if you want unintended consequences of the attempt to strengthen the core of the financial system, the banks, with higher regulatory capital, liquidity requirement, stress testing, and so on. I think one of the unintended consequences has been that some of this risk taking has moved away from the core of the financial system, where regulator and supervisor have visibility and tool to address, to other parts of the financial system. Again, there's different risk profile, risk appetite. So that's definitely one part of the story. Not just the regulation, I think, particularly after the GFC, also the risk management practices that financial institutions internally had put in place, right? A much more risk averse approach. Another piece of this, I think, has been the macro backdrop after the financial crisis. So a long period of low inflation, extremely low interest rate, what we call the search for yield, right? From on the investor side, they reach out in terms of duration, in terms of risk taking in credit to hit some of their nominal risk yield target that they have by mandate, for example. And then I think there is a third component, which is the market structures change over time. We have more technology involved. There are platforms where you can essentially connect directly some of this investor with the borrower without the need to have intermediation through the banking sector.
I know I use the term regulatory arbitrage, which sounds like a pejorative, but you could say that the shift away from banks to these private credit firms is exactly the intention of what these regulations were meant to do. So it's not that they're circumventing regulations, it's that risk should be separated from the banking system and more isolated. To that extent, has the growth of private credit been a kind of intentional consequence of the bank regulations that we saw after the financial crisis?
So I use the word unintended. Perhaps I was too quick there. I think it's a combination of the two, right? Part was the objective of regulation, which was to strengthen, again, the core of the financial system, which is the banking sector. And so as part of that, obviously you have this situation where risk migrate away from the banks to somewhere else. I use the word unintended consequences because I think there was a sense, at least in some corner of the policymaking world, that by imposing some of these rules related to capital requirements, liquidity stress testing, and a bunch of others, that the policymakers would be able to squeeze some of this risk in a sense that it would be diminished at the aggregate level, right? That the financial stability risk would be lessened. I think the unintended part is that instead of lessening the risk necessarily, combined with this background of very low interest rate and search for yield, risk actually moved away from the bank to somewhere else. So at the aggregate, risk did not decline. They were just allocated in different parts of the financial system. So that's what I use the word unintended, because I think there was at least some in the policymaking world had this idea that credit would actually be diminished. And I think that didn't happen. If anything, risk spreads outside of the banks, went to corner, for good reason, but also made, I think, the life of supervisor and regulator more difficult because this investor have a different regulatory or supervisory framework than being used. Now, can I add one point? I think it's important too. It is not true also that credit, that risk completely disappear from the bank balance sheets. And that's one of the risks that I've highlighted in my work on private credit, that the interconnectedness of the system has increased. So not just because you have this institutional investor, now you have retail investor, and we can talk about retail investor later, but because the banks continues to play an important role even in private credit, either through the partnership that they have with some of these private credit funds. So essentially they originate to distribute platforms where banks originate and then they ship out the risk to some of these private credit funds in exchange of fees. That's one piece. So the fee business continues to remain and to be important for banks, but also some of the liquidity and leverage that being offered to private credit funds comes from banks. So if you think of like, I don't know, the ability of the private credit fund, for example, to pool some of these loans and then get financed with haircuts, but those are financed by the bank themselves. So the banks continues to play a role in the private credit ecosystem, this broader ecosystem, providing liquidity services, providing leverage in different forms, and also through the relationship with them in the fee business. So to me, there is a sense that sometimes risk has not really shifted away from the banks. It's just coming back from the inside of the front door. It's coming back from the back door. I don't like the word regulatory arbitrage personally, because it comes with a negative connotation. But if you think a situation where prior to the boom in private credit, the banks would provide, say, 100 loans, right, to 100 corporates. Now, private credit provide those 100 loans, and then those 100 loans are pooled into a portfolio, and the banks provide financing to those 100 loans. The economics is very similar. It's still moving through the banking balance sheet. It's advantageous for the banks because the capital charge for that pool of loans is lower than it would be one-on-one for these specific loans.
So the banks, in a sense, as I understand what you're saying, they are still responsible for that financing, but this private lending firm is an intermediary. So the bank exposure is the same as if we took out that intermediary, but it shows up differently on their balance sheet in a way that allows them to satisfy regulatory requirements, even if the risk has just kind of it's got a different name, but it hasn't changed all that much.
I wouldn't say it's the same. I think the aggregate level of risk, some of this list, the risk in terms of quantity has been shifted outside of the banking sector. So I'm not saying that the entire credit creation of private credit gets immediately refinanced back by the banks, right? Whether this simple example of portfolio financing or whether this through systemic risk transfer, whatever form you use to transfer risk out from the bank balance sheet outside, I'm not arguing that the entire risk comes back to the bank. I'm just saying that a portion of that comes back to the banks. So you could argue that perhaps at the aggregate system, this allocation of risk or spread out to the system, it's enhancing from a financial stability perspective. My only point was that claiming that the risk has moved away from the banks to someone else, I don't think it's exactly correct.
Talk about the recent distress we've seen in private credit. What exactly has happened these past few months to move it to the forefront of investors' attention?
that's why I'm starting to be increasingly concerned. And we put out a piece on Market Watch and op-ed exactly on this point, right? So when we think about private credit, the framework that I used to assess risk and benefits was, okay, what are the traditional financial stability buckets that we would look at, right? Liquidity risk, leverage, interconnectedness. And so one of the ameliorating risk was the fact that there was no liquidity risk as traditionally would have been on the banks, in the sense that the institutional investor in a private credit funds, whether this is life insurance, whether this is pension funds, those are institutional investors. They are more patient and a longer horizon in terms of investment. So there was little liquidity risk, right? These loans have whatever maturity they have. The institutional investor, put money into a fund that has, say, a 10-year duration. So there is no liquidity risk the way we traditionally know for a bank. That, for me, that was reducing the risk of private credit vis-a-vis alternative form of funding. The other one was leverage. I think we have discussed leverage a little bit, and I can come back to that in a second. And then the other component was interconnectedness. So the two red flags in my mind now, one is the interconnectedness. There is an obvious sign that the ecosystem is very interconnected in ways that often we don't fully understand or we are not fully able to quantify. So one example is the link between private equity and private equity owned insurer. So this insurance, they receive money from the premiums, then they get invested into private credit. So they become a constant source of investment into these private credit funds. In some cases, even reassurer are part of the same complex. And the share of illiquid or level 3 loans that this RIFR holds is actually larger than the non-private equity linked firms. And so that's one sign of interconnectedness that I think we need to fully understand, and it could be a source of fragility. The other one is that the liquidity risk, with the private credit sector now venturing not only in the direction of different asset classes, so specialty finance, but it's also in the direction of broadening the investor set. And that's where retail investing comes in. To me, that could be the Achilles heel of the private credit sector, because it's a way to bring back this liquidity risk that the original setup through these private credit funds, closed-end funds with 10-year life horizon, if you want. That approach was reducing liquidity risk. The introduction of this form, whether this is in the forms of publicly traded BDCs, non-traded, evergreen funds, closed-end funds, there is different ways of bringing retail into this, but that tension that didn't exist before between the liquidity of the underlying and the liquidity needs of the investor now is becoming more evident. And that's what we have seen in the last few months, right? We're seeing this wave of redemption requests across the private credit market by retail investors. The way these funds are set up usually, for simplicity, let's say you can only get money back on a quarterly basis, you provide advance notice, and then usually there's a cap, say 5%, right? So at the aggregate level, no more than 5% can be taken back by the investor. Now, this wave of requests have been significantly large, right? There was just today a Bloomberg article saying that over the last quarter, about $13 billion in a dozen or so funds investors been trying to pull money out, but 5 billion got trapped because it was above this 5%. And there's a number of names out there that of funds that have just seen this pressure continue to build up on the retail side, right? Lately, this week was Apollo and Ares. Previously was BlackRock, Morgan Stanley. A couple of these funds, they decided to actually lift the cap, the 5%, but the majority of the other one actually capped the withdrawal. Now, the issue is that was by design. So I think you would argue that these gates work as they've been designed, but I think there is more to that, right? These gates, in my personal view, work well if this is an idiosyncratic event for a single fund. So for fund A, investor want the money back, you have a gate, and that helps the liquidity management of the firm. When this is across the entire system, it becomes a more systemic thing at some point, right? So, and it starts more looking like a liquidity run of the type that we traditionally used to see in banks. And the interaction between this run for liquidity combined with the liquidity of the underlying and the opacity of the mark, that combination of the three, I think that's what's particularly dangerous here. Because for once, even if you can get the money out, it's possible that those investors, if they need liquidity, they need to sell something else, right? And then you end up selling your more liquid investment, whether this is equities or other form of investment grade public credit. Or the way the fund manage liquidity, they themselves at some point would have to sell something, and that's why you get this dynamic of run. Because if I know that the fund will sell probably what is most liquid, I want to be in the front line of those asking for redemption, because I know that the next round of redemption, the fund will be stuck with a less liquid asset, and those less liquid assets, if sold, could be sold at a lower mark. So that feedback between leverage is built there, the liquidity of the underlying, the opacity of the mark. At some point, when you start seeing mark, and we have seen some in the case of Blue Owl, for example, those becomes mark that are actually there for the entire industry. And that's where I think there is concern, right? The lack of trust, essentially, in the NAVs that you see, if that becomes the reason for the withdrawal, combined with the leverage, combined with the forced sales of some of these assets, that's where the concern is. And I think that's what Lloyd Blankfein yesterday was discussing on Bloomberg on this, like the fire sale concept.
So banks borrow short and lend long, and one thing that we've put in place to stop bank runs, or at least give depositors a little bit more security, is the FDIC. And private credit does not have the same public backstop, but they can limit depositor withdrawals. Now, from what you're saying, is there anything inherently risky that is causing this tension? I mean, if there's a run on a bank, it might have nothing to do with how risky or toxic the loans are on the bank's balance sheet. So what we're seeing right now with private credit, is it just effectively a run, a bank run on private credit, and it's not really connected to unregulated nature of it spinning out of control?
The banking system is set up in a different way, right? There is a regulatory supervisory framework. There is an FDIC deposit insurance. And in some sense, to be part of the safety net, you are subject to supervision regulation. They are different than other institutions. The regulation here, depending, obviously, the complication here, one is that the ecosystem is very complicated, right? So whether you are a pension funds, an insurance companies, a retail investor, banks, all of these are involved, all different regulators with different mandate, in some case financial stability, in some case not. So it gets complicated to think this through. The bank is much simpler in some sense. I think my concern is this, that the combination of what could be idiosyncratic events, right? Take the Blue Owl event. There was an attempt to merge essentially two funds. The investor didn't like it. That plan was scrapped, and then people tried to get more money out than the 5%. That was a fund specific. Now we're seeing pressure for redemption across other funds complexes as well. And that's where it starts feeling a little bit more like a liquidity run. Liquidity run doesn't mean in principle that there are credit quality concerns, right? It could be simply this concept that I know that only 5% gets their money back. There is no FDIC insurance. If I don't get to the front line first and I'm stuck in the second or third row, I know that eventually the fund is going to start to sell less liquid stuff if there is a need to, and those less liquid stuff may actually have to be sold at a lower price, and that is going to affect the NAV, so I'm going to get less money back effectively. So I want to be on the front too. So there is this rush essentially to be the first out. That's the dynamic that works. My concern is that there is also reason to start thinking that there are some potentially credit concern underlying, in addition to the liquidity strains. Whether this has to do with the disruption, for example, so all the discussion how much private credit is exposed to software, right? Some of the deals that were done a few years ago have very high multiples. Plus the conjunctural part, or if you want the implication of the war in Iran, the risk that interest rates may be higher, they stay higher at a time when there will be some refinancing coming. And so that is going to affect the underlying quality. The combination of the two, of the liquidity strains, the lack of clarity and opacity on these marks, and the deterioration of the credit quality, all of that stuff, the lack of trust plus genuine concern about credit quality, implies that some of this mark actually could come down. And if the mark comes down, then the deleveraging process, if this fund utilizes leverage, is going to end up essentially magnifying the actual decline in fund value. And you get essentially the reverse, right? That what you get back, it's even less than you would get back if there was no leverage. That feedback liquidity risk, liquidity run, opacity, lack of trust, and credit quality concern, that to me, that could be a very dangerous dynamic within that sector.
Would a lot of these problems just be solved by enacting rules for transparency? I mean, we talk about how opaque the whole sector is, and of course, if people have incomplete information, they often assume much worse than the reality is. If there were laws put into place or regulations so that this private credit lending and borrowing was easier to examine, do you think that would quell a lot of the fears that are causing these pseudo runs on private credit?
So here's the catch, though. For me, one point that I think we need to make clear. Some of the reason why you get a higher yield in terms of return from this investment in private credit is what people call the liquidity premium. Essentially, you invest in a liquid asset, you get a higher yield because they're illiquid, but also you're patient, right? So if you're a patient investor, you can afford to look through some of these liquidity strains, and that's what you get this liquidity premium. That's why you bear some of this liquidity risk. You don't have daily liquidity needs as an investor. You are more patient. You're an institutional investor. That will explain it fits into this higher liquidity premium, the higher return. When the industry decide to open up to the retail sector, and in some sense trade off some of that patient investor for investor that may have different liquidity needs, despite the fact that they think that this can be managed through these gates, the quarterly redemption, and all this stuff, right? Um, that's where the tension comes in, right? Because you essentially provided a door for higher frequency liquidity, but the underlying assets have not changed. And so that's strains, if you want, between the still underlying asset and the additional liquidity, let's call it managed liquidity, that is being offered. Again, it works well, I think, if it's an idiosyncratic issue. It's a specific fund problem, right? The gates and says, you can't get more than 5%. When it's at the aggregate level, when it's an industry-wide process, that tension between the liquidity needs, the higher liquidity needs, and the liquidity of the underlying, that's where you see the tension. Now, one way to resolve this is say, okay, I'm going to impose greater transparency, greater reporting. Now, that address the liquidity piece of this, but the question then is, are you still going to be able to reap this illiquidity premium, right? Because at some point you're pushing in a way that is going to compress the liquidity premium because you require more transparency and more visibility in the underlying. Some of these assets don't trade. There is no mark. They're mark to model. Now, one thing that could be done, some of the asset manager could be relying more on third party, for example, for assessment, like for valuation, for reporting. A lot of this often is done in-house. So the valuation, the reporting, the auditing, it's all done in-house. Requiring that some of this is done by external third party that have no stake in this, that probably would help increase the transparency. It may end up increasing the trust into NAVs, into marks. The question that remains for me is, though, you are essentially eroding some of this liquidity premium. That will come at the expense of some of the extra yield that you get in some of these deals. Are people understanding this? Are they ready to trade off that more transparency for a lower liquidity premium, or the asset class will lose its appeal in terms of returns if you introduce more this liquidity? That's why opening up the door to retail investor raise a number of issues that I think I think the industry could have taken more time studying and thinking this through, what the second and third order implication of that would have been.
You talked about private credit's exposure to software, and maybe you even mentioned an energy shock. So I'm curious what you think the biggest sources of vulnerability are. So we're just about 3.5, 4 weeks into the war in Iran that's caused energy prices to go up. And even before the war started, there were these big swings in AI sentiment that were driving financial markets. So where are the biggest sources of vulnerability for private credit?
Again, one is about the interconnectedness of the system. If something goes wrong in one corner of the system, whether this investor, because they can't get the money out of this private credit fund, whether it's an institutional or retail, and they need liquidity, say because the economy is deteriorates, they want to raise their cash holdings, whether they be incentivized to sell something else, right? Say sell equities or sell publicly traded investment grade debt. That would be one way essentially to have spillover from the ecosystem of private credit into other asset classes that will contribute to a tightening of financial conditions. So the interconnectedness, more sure. The other one is the credit quality. One thing that it's worth mentioning and highlighting is we're seeing all this concern about, in part, is sectoral, right? It's the AI disruption, the software that have been financed by private credit. Some, at least some private credit firms have very high multiples and now have been questioned in terms of viability or profitability by AI itself. Some of it could be the energy issues. One thing that it's important to highlight is that we're having this credit concern at a time when the economy, at least pre-Iran Iran conflict, was growing strongly, right? So this is the concern, that if you are concerned about credit quality when the economy is strong, a deterioration of the asset quality can only accelerate the economy starts slowing. And so that's, to me, the biggest concern. If the conflict drags on, if interest rates stay high because there is an inflation concern, if rates are moving higher along the curve, policy rates as well, long-term rates, that would put pressure on the credit quality. Remember, those are, for the most part, sub-investment grade firms, right? Some of them are investment grade, they are playing different markets, the larger one. But the smaller part of the market, it is middle market. They are unrated, sub-investment grade when they are rated, so they're riskier. So they are more exposed, right? Think about like the Russell 2000, when the economy goes down, tend to decline much more than the broader market. You can think of this in similar terms here. And so if the economy slows, if the conflict drags out, if rates go up, if there are fiscal concerns, the credit quality is likely to deteriorate. And if the credit quality deteriorates, you're going to get this interaction between liquidity runs and liquidity strains with underlying credit quality, with forced selling. And you have this spiral, this scenario, a negative spiral that would test the private credit markets the way we know for the first time, right? Remember, the market has grown over the last 10, 15 years exponentially. And so this market never really went through a true recession that did not involve the Federal Reserve backstopping of financial markets. If you take out the COVID episode, so specific events where the Fed stepped in and decided to set up a bunch of facilities to backstop financial markets, taking those out as outlier for a second, this segment has never went to a full-blown recession in this size. We have not run the counterfactual, and that's where I think some of the concerns are.
So, one path, as I see it from what you described, is let's say interest rates go up, energy prices go up, and so AI data center investment goes down or becomes less economically viable. And AI data center investment in software was such a big part of growth in 2025. So if that goes down, maybe it starts this cascading effect where economic growth slows, and then suddenly we exacerbate that feedback loop between liquidity needs and concerns about credit quality. And that's just kind of one source of how the dominoes could fall.
Yes. So pick an example, right? A few days ago, Moody's downgraded one of the KKR publicly traded BDCs to junk. One of the reasons was the deterioration of asset quality. So you can think of a scenario where that deterioration of asset quality is broader than just idiosyncratic sector. It becomes the aggregate economy that has been subject to stress in terms of credit quality. That's where you would see, I think, this liquidity request will accelerate, probably in the retail investor side. At that point, it's not just I want to get my money back. I really want to get my money back because I think that the underlying credit quality is deteriorating. I don't really trust the NAEs. I really want to get the money out. And if you start forcing some of these funds, particularly the retail side, to actually liquidate, that's where the fire sale scenario comes in. I'm not saying this is the central scenario. I'm just saying that there are some fragilities, some of which have, in my view, this vulnerability have increased individually, like the liquidity risk, the credit quality, the opacity. Doesn't take too much to set up a scenario where they start interacting with each other. And that's where, again, the segment would be tested. Doesn't mean it doesn't have to be a financial crisis, right? People always jump to a financial crisis. It doesn't have to be a financial crisis, but I think from a macro financial standpoint, in terms of credit provision to the economy, it could be a significant amplifier of the downside of the economy. So even going into the concern about a fully blown out financial crisis, if the economy slows and this sector that has such an important role in terms of credit provision to a part of the corporate world, if this sector freezes, this would be a significant amplifier of this slowdown of the economy.
So let's take that scenario where systemic contagion is quite limited, but private credit really contracts or, I don't know, disappears to some extent altogether. Will there be a credit crunch for certain institutions, or does it just shift borrowing to alternatives? Are we still in a situation where a lot of the institutions that have relied on private credit don't have access to lending somewhere else?
The industry often use the COVID example as a different narrative. Right? So their argument is when COVID struck, the banks, as usually banks do, they became very risk averse, they tightened lending standard. We didn't, and we continue to provide credit to middle market firms. And there's a lot of example of credit provided by private credit funds to, I don't know, a gym, a store, a family business. Now, to their credit, I think there is enough anecdotal evidence to say that this is true. Obviously, credit was very expensive. It came in different forms of credit, whether this was refinancing some of these loans, or whether providing distress credit, or whether it's in the form of equity. But it is true that they stepped in. There is, I think, anecdotal evidence to show that. Now, I would add also, though, that at some point, rather quickly, the Federal Reserve stepped in back in 2020. So I don't know how that counterfactual would have played out if the Fed didn't step in. Would private credit continue to provide credit, or would at some point unplug the way the banking sector seems to be doing it? So I would be a little bit more cautious than that narrative because we don't have a counterfactual. So if private credit gets unplugged and doesn't provide credit, I don't think there's much evidence, historical evidence, at a time of a recession, banks step in and they play the role that other institutions play in terms of credit provision. Bank would do, from a risk management perspective, what is rational, which is tightening underwriting standard, maybe continue to service their largest client. But I'm not sure I can see a scenario where private credit stop providing funding to the economy, to the real economy, and banks in a recession, they decide to step in. Now, there is a rethinking of the rules, the capital rules and other rules by the Federal Reserve. That would free up some capital, some balance sheets. Whether that balance sheet in a recession will be used to try to take some business back from private credit or not, I am personally skeptical, but I would be happy to be proven wrong, obviously.
I want to end with a question about, let's say, a hypothetical scenario where you are the regulator in chief. What would you do to make sure that the financial system maintains the positives of private credit while still limiting or eliminating the weaknesses of it?
I would start from one observation, which is it's very important that supervisor or regulators actually have a dialogue with the players in the private credit and fully understand how this market works. This market has been growing very quickly in terms of actual aggregate growth, but in terms of also of instruments that are being used. There's a lot of very complicated financial engineering that is being used, right? From, I don't know, stuff that is being used to move risk out of the balance sheet of some specific financial institution, from collateralized fund obligations to very specific note feeder structure that they show up during period of booms. And I think it's important that the policymaking world is actually out there having conversation to better understand new form of risk and to map the ecosystem, where risks are, what form of risk, who's exposed to those risks, which specific players in the ecosystem. It's very hard to map down and especially quantifying, I think, the interconnectedness of the system. The second one, I think you need more transparency, with the caveat that more transparency will challenge this illiquidity risk premium. And so I think people need to fully understand that there is a trade-off there between the returns that you get and what we need or we want in terms of liquidity. Third, I think personally that opening up the industry this quickly to the retail investor has been a mistake, has reintroduced from the backdoor a liquidity risk that did not exist when only institutional investors were there. I think what has been used in terms of liquidity management at the fund level don't work on a systemic level. And the risk there is that you get this fire sale and this feedback that we have. So I would rethink the opening up of the industry to the retail investors. And I think we need a better understanding what the risk they are coming back from the back door and whether the structure and the liquidity tools that are in place are appropriate at time of a systemic liquidity stress. Last point, this is very different than banking. There are many players involved, from retail, wealthy investor, institutional investor, insurance companies, pension funds, private credit, asset manager. The way the regulatory framework is set up in the US, it's very fragmented. This requires different policymakers, regulators, supervisors on the other side, not just the banking world, the federal banking regulators, but now you involve a number of federal agencies here with different mandates. Not everyone has a financial stability mandate, not everyone the appropriate tools to deal with it. So it becomes much more complicated in terms of crisis management to manage this ecosystem than it is to manage banks. I think there has to be some thinking about what is the appropriate crisis management framework in the event of a systemic event in this ecosystem, in the private credit world. So I think the tools available now and the fragmentation of both mandate and tools and objective is not conducive to a quick response in case there is stress.
Fabio Natalucci, thanks for coming on the podcast.
Thank you so much for having me.
That was Fabio Natalucci, Managing Director at the Andersen Institute for Finance and Economics. I think my biggest takeaway from that conversation is how vulnerable private credit, and potentially even more of the financial system, could be from one big shock. If growth slows from the recent energy price increase, for example, deterioration of credit quality could start a domino effect that causes a fire sale in the investments held by private credit. Or, if interest rates stay elevated, it could tighten financial conditions in a way that exacerbates any existing cracks in the sector. And even more, because it's hard to tell how much systemic risk there is given the lack of transparency, these fears may linger into next year while investors keep waiting for the next shoe to drop. Meanwhile, investors will continue focusing on war developments in the Middle East for the foreseeable future. The data slate over the next 2 weeks features a combination of releases looking at the pre-war economy and data that capture initial economic impacts of the war. The ISM services on Monday, April 6th is for March, as is the CPI report published on Friday, April 10th. The CPI in particular should reflect the dollar increase in gasoline prices last month, though the war's full impacts on prices will emerge with more of a lag. PCE on April 9th is for February and won't reflect any impacts from the war, but will probably get more attention than the CPI because of the PCE deflator's role as the Fed's preferred inflation metric. PCE inflation has been running hotter than the CPI for some methodological reasons, so any cooling in the March CPI could be dismissed by the bond market if the PCE stays stubbornly high. The minutes from the Fed's March meeting will be released next Wednesday. Fed officials have made it clear that they will remain patient to see how the war affects the two sides of their dual mandate, but the minutes could provide color on whether they believe an energy price shock will be temporary or more sustained. A handful of public appearances from FOMC participants dot the calendar over the next 2 weeks, before the next pre-meeting communications blackout begins the evening of April 17th. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.